today's video, we're going to be talking about Disney. They released their earnings yesterday after market. I was not able to make a video because the audio or the noise around me is just too loud. Let's talk about some quick disclaimers, and then we'll talk about the broad overview of what I read. Then we'll break down kind of just the individual analysis, then we'll talk about it again. First of all, I own Disney stock. I own their shares. I'm kind of biased towards this, so I just want to get that out of the way. This is not advice. I'm just breaking down my opinions on their earnings report. Next, I want to break this down. They're foregoing their next semi-annual cash dividend, so they have not declared a dividend for the second half of the fiscal year. Usually, they'll do a dividend or two dividends each year. They're not doing that, especially they didn't do one last year as well. They're prioritizing investments to direct consumer initiatives. Now, this might seem like a bad thing. Oh, I don't get my dividend, whatever, yada. But the dividend already was quite small. And by them not doing this, they're able to put back in the company, I think it's like $2 billion each year, or each semi-year. I think $2 billion each year back into the business, and they're prioritizing the direct consumer specifically. That I really like, because real quick, we're going to talk about this more, but Disney, obviously they have their parks, they have their cruise lines, but what they really have is this platform, Disney Plus specifically. I like where customers go to interact with just their content and their franchises, and they have exclusive rights to using that content. That is so powerful. I think they're noticing this, and they're going to create more content and basically compete with, let's say, Netflix, or I'm kind of drawing a blank on the competitors, but Netflix is the big one, the other streaming platforms. Anyway, let's get into the report. So they received the first loss. I think this is a loss in I forgot exactly when. Anyway, I can't find it, but basically Disney reported a loss for the first year. Like, all EPS lost in like years. So this is pretty big and pretty bad news. The most significant impact was in the parks. Obviously, it just makes sense. The bright spot has been our direct-to-consumer business, which is the key to the future of the company. This is important. This is what the CEO, Bob Chapek, said. The key to the future of the company. They identify how important and how profitable their direct-to-consumer business is. That's why they're cutting the dividend. Not only they're not making money to begin with this negative EPS, but they want to put the money that they could be, any money they can find, into boosting this direct consumer. I do like that a lot about the company. They had 73 million paid subscribers, far surpassing the expectations in the first year. In just its first year. To talk about specifically Disney Plus, this platform, guys, I am very bullish on, to say the least. Now let's go down to some specific numbers. Revenue, quarter end, year end, down 6%, so they're not doing really too good at all. Operating income down 82%. Quarter end, man, that's so bad. They're getting destroyed. There's nothing to really see here other than they're getting decimated. But this negative 82% for the quarter end for 2000, this quarter they did not do good at all. I mean, even the year, like everything, just not good. They talk about why, but I think it's obvious the parks and stuff are not generating any income, so. Now here is some income real quick. Quarter end 2019, they're not making, not making any money. Obviously, again, see, last year at this time, about 14 million, now they're negative 1.7 million. See can hear the numbers we looked at above. Parks and experience and products, where theme parks were closed or operating at significant reduced capacity for a significant portion of the year. Cruise ships sailing and guided tours were suspended. Retail stores were also closed. Yeah, it just makes sense, everything we already know. We've experienced significant disruptions in production and availability of content. So again, I think was it the Mulan, they were not able to bring to theaters and stuff. massive, or lose a lot of money next year as well to recoup the stuff they need to do that happened this year. So their most significant impact this quarter, 2.4 billion on operating income in parks, 6.9 billion in products and segments. Yeah, media network, studio entertainment, directing, consumer were less significant. That makes sense just because it's more at home, stay at home stuff. And one thing to note, I noticed this with Google as well. Recently they have a lot higher advertising revenue, and it's reflecting the shift. So we'll talk about this again in a second. I don't want to do it here with a specific section. At studio entertainment, lower revenue due to deferral, cancellation of significant film release. So yeah, they obviously made less money, but one of the reasons was because they just didn't release anything at all. Like, you can't make money if you don't release anything. Here's a breakdown of this is the breakdown of just each revenue network. So media, parks, studio entertainment, direct to consumer. Basically, parks and let's look at the operating income, which just makes it a lot better. 61% studio entertainment. Oops. The only thing they're really making money again is direct to consumer, and media networks. But again, direct to consumer operating income 22%. That's good, but they're still, I guess, aren't really making money in the direct to consumer. So something to keep in mind. Okay, let's go down. Here's their media network specifically. We can see the breakdown. They're up 21% for the year end. The cable networks, the decrease at ESPN was due to higher programming and production costs, partially offset by affiliate and advertising revenue growth. Higher FX networks results were due to a decrease in programming and production costs, driven by fewer hours of original programming and lower marketing costs. So just kind of talking about, what happened here with the numbers. Let's go down to broadcasting. The increase in operational income was due to affiliate revenue growth and lower network programming production costs. Decrease. Okay. Advertising revenues were comparable to prior quarter year. Company.new. So we'll talk about that in a second. Advertising revenue is basically back, at least for Disney, from the lower last quarter, prior quarter. I mean, this is a good thing because companies obviously want to push their products or advertise their products in front of, or just in general, right? If there's more competition out there, it's going to drive up the market to increase prices, especially if it's advertising, specific. So this was something interesting too. The company adopted new accounting guidelines. They expect to utilize on our direct consumer services compared to the previous accounting program and production expense, which would be lower in the first half. Why'd I write this down? Generate results in lower. I forgot why I highlighted this, but I think it was important. They're basically, again, expecting to use their direct-to-consumer service. So this broadcasting revenue will probably decrease. I think that's what they're trying to say. But that's just because they're pushing to a more specific, business tool. Talk about the parks. Nothing to talk about actually here. Estimate 2.4 billion loss. It stinks. So studio and entertainment, the same thing. Lower theatrical and home entertainment. So they're just not making any money. They're not making any content. They're not making any money. It's just bad. So this is a huge part of their portfolio. We'll see that in a second. But the light at the end of the tunnel is the direct-to-consumer brand, or how they're, just that. If they can grow it to a sustainable amount where it's a larger percent of their business, that will be, that's almost what I'm banking on, and I want to get in before that. The improvement on Hulu was due to subscriber growth and increased advertising revenue driven by higher impressions. Higher results at ESPN were driven by subscriber growth and higher income from Ultimate UFC pay-per-view. Decrease lower affiliate so international channels, lower affiliates and advertising revenues. Let's go down. So these are subscriber growths, or paid subscribers in millions. One thing I want to note is they again just started Disney Plus this year, I just want to highlight this as kind of a key point. They're in other nations or other countries such as India and Indonesia, the revenue is much lower, and I think they just did kind of an estimate. So this number might not reflect the exact amount. So ESPN decrease was due to a bundled subscription. This is going to be a very common trend. Also Hulu and whatever service, another bundle subscription. That's why some revenue might be a little bit less. Especially this specifically. That's what I meant. So they just bundled it together. I don't like this decision because let's say I want Disney Plus, right? But I don't want ESPN. Like I don't care. Like I think it would be better to not. It just makes sense to. I don't know. That's why just not buy everything in one big bundle. I'd rather have separate packages. This way it's cheaper for people and they value it more. This is some eliminations. Not gonna really get into that. So for restructuring and impairment, they recorded almost 400 million. I guess last quarter and this quarter 314 million. So a lot of money. I thought this was interesting. This year they took on a position in DraftKings. So they have a non-recognized investment gain in DraftKings of almost $600 million. So they have a huge position in DraftKings. Not huge. I don't know exactly what their position, how big of a position they have in DraftKings, but to have a gain of 600%, million, it's pretty big. Here's some other stuff. This is important, but equity and income, investees decreased, higher direct consumer. Yeah, it doesn't matter too much. Let's talk about some cash flow. Increase in cash flow provided by operations due to the increase in cash provided by operations was due to lower income tax payments and higher collection of tax accounts receivable, partially offset by lower segment operating results and increased spending on film and television production. So since they have been reporting basically no income made this year, they're obviously gonna have a lot lower tax, just being given to the government and states and stuff. So this is more cash the company can use, which is a good thing, but it's also bad if they're not making money. But yeah, they do have more cash on hand than last year, but they also need it more now than ever to pay employees and stuff, especially because they don't have that income. Here's some capex and depreciation stuff. Nothing. We can skip this for now. Okay, here's their statement of income statement. Take a look at the revenue. Revenue's down about 4 million. We can look at the year end. It's a pretty good amount. Not a lot though. I like to mostly look at the income before, or I guess, how did I do that one? Income taxes. I guess income just on continuous operations, down a significant amount. Jeez. About, I don't even know, 15 million. 15 million swing. Not good. Just EPS doesn't look good either. Even the shares, they diluted it a little bit. Actually, if you compare it to year end, quarter end, they actually didn't dilute it. It depends what number you want to look at. But prior, in comparison to the last year, they diluted about, was that 150 million shares, something like that. Their income statement is not pretty. They are not making money, and so that's where their balance sheet comes in. How are they handling on a fundamental level? Total current assets, they have more than last year. That's probably offset a lot by how much cash they have. They have 3 times the amount of cash, and yeah, that's good. They have liquidity, and I guess they can spend stuff, but you'd rather have it in especially receivables almost, just because that means that people bought your stuff, and I'm not gonna get too complicated into that. Goodwill. I'll talk about in a second. Total assets. They're sitting at about the same amount of assets as last year, with this huge increase. It's just because this massive increase in cash. Depends how you want to look at it too. Goodwill, they actually wrote down 3 billion more. do like to look at equity as a means of I guess, the percentage or the strength of the company that is owned by the shareholders, and you always want this number to be increasing, but we'll make some exceptions because, just the events that are happening. Treasury stock it cost 19 million shares, so that's where this number, if you add 906 million, is that right? To this, that doesn't seem right. They did something here. Alright, I'm just gonna pretend. We're not gonna talk about that because I don't want to say something stupid. Let's go down to cash flows. Again, they're not making any cash. They actually, net income compared to last year, they made about 11 billion net income. And this year they lost about 2.5 million, or billion. Oh wow, yeah, 10.5 or 11 billion. And they lost 2.5 billion about. Yeah, big numbers we're talking about. I always forget exactly what we're talking about. Take a look at the cash provided for continuous operations. Their cash provided is actually, it's more. But now, why is it more, right? And I guess a big one here came from receivables. Now, the big number here is goodwill and tangible asset impairments. Again, like, about 5 billion came from this, and it did nothing from last year. And this is probably from the Disney Plus. The only thing that I could really think of that would have this big increase. That if someone wanted to buy, that's kind of what they're valuing that at, maybe. Let's just skip this investing. Yeah. So the cash at the end and beginning of the period this year they had, or this quarter, year end they had 18 billion about. I did the difference and change of that. That's good. It gives them liquidity and fluidity to move throughout the company and what they need to do. Yeah, this is a very important page, especially in Disney's like life right now, where they're putting their money and how they're doing it. But man, it's kind of hard to break down. Not very hard, but it's just kind of hard to break down. You can see they spent a lot less on investing, and you can see 10 billion last year just in 10 billion last year in acquisitions. This year they have nothing. So this means they actually sold something for a profit. I don't remember. They probably mentioned it somewhere, but let's see. This number's very big. This number's a lot bigger. This number, they paid a lot. So yeah, wow. They paid, income taxes 152 million as opposed to 6.5 billion last year. That gave them a lot more money to move or to use. Net acquisition, same thing. Net acquisition, definitely a big number here. Their cash flow from the prior year to this year is completely different. I mean, for obvious reason. Yeah, it's just interesting. Anyway, let's continue. That's actually it for that. Okay, let's just break down the technicals real quick, and then we're gonna wrap this up and kind of my thoughts. Yesterday earnings released, it actually shot up to 143. This is like a very high level back from here, right around here. Then it kind of faded off, but now it kind of looks like it wants to fade. Obviously, we got these heavy candles. Market doesn't open for another hour. If it gets down to here, maybe I'll pick up some more shares, but I don't think it will. Probably gonna get this pre-market right here. This isn't gonna matter. I'm a long-term investor in Disney, but finding some little moments to buy is important. What do I see about this company? They're obviously getting clobbered. Their direct-to-consumer stuff is the key to this business's success. streaming service company, direct to consumer. I think this company is going to be very expensive very soon because of just how this market is working. There's something, yeah, so despite Disney losing money this quarter, despite a lot of their revenue falling, or just they're not making money, they can't do anything, why is the stock jump 6% off of bad earnings? And again, that, for my opinion, it's because people notice the value of the direct-to-consumer brand. It is so powerful, in my opinion. And because it's so scalable, the margins are quite good, I guess. They just have to build and make more content, and because they decided, and they specifically put, even in the first few pages, even like in the first page, how they think is the key to they literally highlighted it. Bob Chapek highlighted it right here, first page, front and center, how important it is for the company. People that notice how impactful this will be for the company in the future is pricing it in now. I think they definitely need more content. There's problems with the platform, but I think this, in the next year or two, will have a much larger impact on the total revenue brought in by the company, assuming that parks and everything are up to, or get back to where they were before. This company is great in my opinion. They are facing a very